Good morning, or good afternoon, or good evening, wherever you find yourself. Welcome to this CSIS event, China's stimulus package. Will it work? I'm Scott Kennedy. I'm Trustee Chair in Chinese Business and Economics at CSIS, and I'm delighted to welcome you to this conversation about China's stimulus package, why it was implemented, what its likely effects are going to be for China, and the implications for the rest of the world. I think just about everybody watching today recognizes that China's economy has not performed as well as many had hoped. Even according to official statistics, it's not hit the mark. Conversations with investors outside China, households and business people inside China, all have shown a low level of confidence in the economy and where it's headed. In the final week of September, Chinese authorities unveiled a multi-part stimulus package with monetary policy changes, lowering interest rates, changing the reserve requirement ratio, how much banks had to hold on to, housing market support, and said that there would be a very large fiscal spending package as well, and potentially other policy moves as well. This is supposed to be the big bang that gets this economy moving again. What's it all mean? Is this part of a broader plan that was signaled in July at the third plenum, or is this a sudden act of desperation? How big actually is this stimulus going to be? What will be the short-term effects? What will be the long-term effects? China's stock market at the very end of that week jumped about 30% to hit a high that it hadn't seen in a while. There haven't been indicators of public confidence or consumers or producers since, but we should see those soon. But I think everyone really wants to know is what does this mean for the long term and addressing the challenges that China's economy has had as it tries to transition away from real estate to depend on other growth drivers? And what's it mean for everybody else, China's trading partners in Asia and around the world? We just saw the EU announce that it would go forward with its tariffs. What's it going to mean for trading partners in Europe and in the US? And what's it mean for China's overall relationship with the United States and others? We're going to have a discussion with a great group of panelists today. And those of you watching can submit questions to all of us on the webpage for this event at csis.org. And we'll get to those soon. Let me, though, first introduce our panelists, and then I'm going to ask each of them an opening question to get their feedback, and then we'll take things from there. Logan Wright is Director of China Markets Research at the Rhodium Group, and he's also a non-resident expert with us here at the Trustee Chair. His work focuses on the impact of credit expansion on the Chinese financial system, China's exchange rate policies, and the influence of the country on global currency and capital markets. Wright holds a PhD from George Washington University and is based here in DC after having lived in Beijing and Hong Kong for over 2 decades. Mary Lovely is the Anthony M. Solomon Senior Fellow at the Peterson Institute for International Economics. She served as the 2022 Carnegie Chair in U.S.-China Relations with the Klug Center at the Library of Congress. She's also Professor Emeritus of Economics at Syracuse University's Maxwell School of Citizenship and Public Affairs, where she was Melvin A. Edgar's Economics Faculty Scholar from 2010 to 2022. And she was co-editor of China Economic Review from 2011 to 2015. And her current research projects investigate the effects of China's foreign direct investment policies on trade flows in entry mode, strategic reform of U.S. tariffs on China, and recent movements in global supply chains. Brian McCarthy is managing principal of Macrolens, a global macro research advisory focusing on China. From 2011 to 2018, he served as chief strategist and portfolio manager at Emerging Sovereign Group, where he managed the Nexus Fund, a China-focused macro hedge fund. Brian also has experience in asset management as well as in sales and trading. So it must be a busy time for him and all the people that he is talking with. Craig Allen began his tenure in 2018 as the president of the U.S.-China Business Council, a private, nonpartisan, nonprofit organization representing over 260 American companies doing business with China. Prior to joining USCBC, he served as the United States ambassador to Brunei from 2014 to 2018. He earlier served as Deputy Assistant Secretary for China at the Department of Commerce, as well as Deputy Assistant Secretary for Asia at the International Trade Administration. He has had an amazing tenure as president of the U.S.-China Business Council, and I think folks who've been watching have heard and seen the council report that Craig will be stepping down soon, and a successor has recently been named. I can say that that successor has huge shoes to fill. This is a great group of experts to talk about China's economy and what it means for the rest of the world. Thank you all for being with us. Let me first turn to Logan and ask you, Logan, if you would. First, why do you think the Chinese leadership came forth with this package and did so now? And secondly, you've been quite worried on the record about the growth of the China's trajectory for some time, with a focus on how the debt picture nationally and at the local level is a hard constraint on growth. Now, the Chinese stock markets responded positively just before China went on vacation. When China comes back from vacation, where do you think China's economy is going to head in the next few months? And is this the opening toward greater reform and stronger growth looking ahead?
Thank you, Scott, and thanks. Appreciate the invitation. Thanks to everyone for joining. I would just make sort of 3 points about what's happened sort of over the last week and a half or so. The first is that the need for policy support for the economy was obvious. It was building, and it was always going to likely take place over this September to October timeframe. And so why did there need to be some kind? And so it was a little earlier, I think, than some had expected, because a fiscal policy adjustment and a mid-year budget revision would usually happen in October. But at the same time, this is, I think that this is, there was a clear case for additional support. Why did I say that? First, credit growth was at an all-time low. We were already seeing credit weaken. We were seeing the price growth weaken. Credit was at, roughly about, bank asset growth was about 6.5%. In around mid-year. These are among the lowest rates that had ever been posted. Same with household, TSF growth, as we had seen. Deflationary pressure was building within the economy. Consumption growth was extremely weak. And ironically, even though everyone had talked about the property sector as the most substantial source of weakness in China, it was actually starting to stabilize, and the real weakness in cyclical momentum in investment growth was from infrastructure and from local government spending as well. So there was clearly going to be a need for some sort of policy support. I think in terms of monetary easing, the Fed move provided China with a bit of a better opportunity to respond, as the constraints they face on monetary easing are usually tied to not only the pressure on the exchange rate, but the pressure on bank profitability. Second point I would make is that, what's the significance of all of these moves that have been taken? I mean, I think they're more about changing the range of expectations about policy, really, rather than the central tendency of where the economy is going. So this is, triggered this optimism in markets, which is logical, because it's made the government look more responsive to the downturn in cyclical momentum. And if you look at the PBOC presser that took place last Tuesday, a lot of it was very clearly focused on foreign investors and very clearly focused on the equity market in particular. The equity market equities are not widely held within the Chinese system. It's not typically seen as a mechanism that would sort of boost the broader economy. But I think there was sort of an effort to try to generate some sort of positive confidence that would be readily apparent, and to show that you could try to recatalyze capital inflows into China's system. So, one anecdote from the press conference is that the Pan Gongshang PBOC governor unveiled a new facility to lend directly to non-bank financial institutions for the purchases of shares or for buybacks of shares. And no one really asked about it at the press conference. So they planted a question with the Financial News, PBOC's newspaper, at the end of the press conference. And in order so that they could get out their talking points. So a lot of this, I think, was very externally driven toward the stock market specifically. And that is, I think, how you should interpret what is taking place. It's not that 20 or 30 basis points in interest rate cuts has a major impact on credit demand or a major impact on animal spirits. But what has adjusted is perhaps there will be a higher floor under cyclical momentum for the next year or so. And perhaps there's a greater range of policy support that can come online, which is the third point I would make, which is a lot depends upon the fiscal package that will follow this. Usually, a budget revision, China's only done one mid-year budget revision since the Asian financial crisis, and that was last year. Usually a mid-year budget revision would take place around, there has to be a National People's Congress standing committee to have that meeting to authorize that. That could occur at any time. Last year it occurred in mid-October. So a lot depends upon how this money, additional fiscal spending, will be spent. There are media reports out there from Reuters and Bloomberg saying that perhaps this could be a shift toward more consumption-oriented stimulus. And we don't really know exactly what that looks like. There have been numerous calls from within the Chinese system for transfer payments to households for many, many years. They have started to build back into a crescendo to fight deflationary pressure this year as well. If you believe the Reuters and Bloomberg reports, there's going to be roughly a $2 trillion kind of budget revision, which would be about 1.6% of GDP. But it depends how the money is spent. China is already running a significant fiscal deficit, including central and local governments, about 7 to 8% of GDP this year. Tax revenue is declining by about 5% so far this year. So, it raises the question of, yes, you can issue more bonds, but do you just want to pour money back into the same industrial policy priorities, or do you want to shift priority as well? There are some indications from media reports that there will be more consumer trade-in programs for durable goods. Those typically just sort of pull demand forward rather than really fundamentally shifting perceptions of incomes. But there's also the prospect that this could pave the way for a broader kind of system of transfer payments to Chinese consumers. So I think that's the significance of what we've seen so far.
Okay. Well, thank you, Logan. We're having a little bit of challenge with your microphone. We could hear everything you said. It just was occasionally got a little garbled. So if you just maybe work on that, change a battery or two, we'll come right back to you in just a little bit. So I'm going to turn now to Mary Lovely. And Mary, do you see more clear, definitive upside with this stimulus and expect it to have a more consequential effect than Logan just described? In particular, given your focus on international trade, what do you think this is going to mean for China's trade flows? Do you think this is going to lead to an increase in imports and hence helps boost global growth? Who are the likely international winners from this policy shift?
Okay, thanks, Scott. It's nice to be with this group on this important topic. I guess I agree with Logan. I don't see it having a more obvious effect until we see a bold fiscal package. This monetary stimulus is often termed a bold package, and in some way it is because we see them moving in it and basically making the signal that we've been waiting for, which is that they understand that the economy is really, I think, at kind of a knife edge. Logan mentioned the deflation. I think the deflation issue has finally hit the upper echelon of the party, and they're understanding that deflation can lead to a very negative cycle. So there's lots of folks watching this, including in Japan, and saying, haven't we done this? Didn't we learn lessons? So that's the good signal, but it's kind of weak tea given the problems that they face. I will talk specifically about the external sector because I think Logan's covered a lot of the ground on the package and what we need to look for next. On the external side, first of all, there's been a lot of concern in the West about China basically relying on net exports to grow out of this. And that, I think, was in some sense unwarranted concern because exports net are just not large enough to dig China out of this hole. China's exports as a share of GDP now are below 20%. That's fairly normal. It could, for a country of its size, it could be lower, but nevertheless, it's just not enough to dig them out. The second point about exports is that a lot of money is going into the new three. So focused on EVs and other green energy products. They're less than 5% of China's overall exports, even though they use up about 99% of our attention lately. The problem is not so much weakness there, but weakness in what we might think of as the old three. So apparel, furniture, and household appliances. And that's almost 10% of China's exports. And I would add more labor intensive. So it really speaks to the need for China to create jobs, I think, quickly as people's confidence continues to decline. Looking at just at exports, since the pandemic, we have seen a very dramatic shift in where China is exporting. Its share of exports that go to high-income countries has been declining quite rapidly. Its share of exports to low and middle-income countries has been making up the slack. As many observers have noted, China's share of global exports really hasn't budged. That means they have to be going somewhere if they're being deflected from the West. That's a bit of a problem for China. First of all, these are different types of goods. Second of all, they almost surely have lower margins. And thirdly, they require new investments from Chinese firms and who can expect to have a lower rate of learning from penetrating these markets. So I think the Chinese officials would look at that and say, well, that's great. That's part of our outreach to the rest of the developing world. But from a commercial and growth perspective, I don't think that's a positive. So, and the last thing I want to mention is, of course, increasing geopolitical tensions. You mentioned at the top of this program, the tariffs going into effect in the vote we had this week in the EU to implement the tariffs. U.S. very likely to continue with more export controls to China, continuing its efforts to move supply chains away from China. I think part of the U.S. strategy so far has been to just put tons of uncertainty into global supply chains, and that is causing firms to move or at least create alternatives. And ultimately, that builds more competition for China. So I think that for all these reasons, we're not going to see the external sector coming to the rescue here. We're going to have a solid fiscal package to get the economy back on its feet.
Okay, so it's a good foot stomping that conclusion. Let me turn to Brian and see how things look from his world, because you advise a lot of institutional investors. You've been an institutional investor yourself. What's been the reaction that you've heard from folks that you've been talking with over the past 10 days? Might this make them more interested in re-expanding their investments toward China? And if not, what would be the signal they would need for their behavior to change?
Sure. Thanks, Scott. So let me start by noting that there's a real dichotomy between speculative investors at hedge funds and the like, and the more medium-term types who run long-only money at the big asset management shops. For some reason, among the hedge fund types, the Chinese equity market elicits FOMO like no other. Everyone is always afraid of missing a rally, perhaps because unlike most markets that tend to go up the stairs and down the elevator, Chinese stocks do tend to go down the stairs and up the elevator, and catching an elevator ride like we've seen in the last week or so is pretty alluring. So when we get a policy signal like we did last week, that speculative crowd is always ready to pounce. But I would point out that while this rally is pretty spectacular, this is the fourth time since 2021 that this crowd has tried to jump on the bandwagon for the next big bull run in Chinese stocks. Now, of course, the hedge fund types tend to be contrarian investors, and their bullishness in part stems from the fact that the long-only folks at the big asset management companies have tended to run underweight Chinese equities in recent years. And I suspect the more pertinent question for our audience today is whether these folks are going to chase the price action and get more involved in Chinese equities. And I'm skeptical that that's going to happen. For one thing, being underweight Chinese equities has been the right trade over the past 3 years or so. But more importantly, most of these investors are underweight because they believe some version of the type of story that people like Logan and I have been telling over the past few years. So let me quickly give you my version of that story to explain why I think the more medium-term investors are going to have to see a lot more than we saw last week to get re-engaged with China. So we should be clear that as far as the stimulus goes, we don't yet have the critical piece of information, which is the size of the fiscal stimulus. So we have the Reuters story from last week, quoting unnamed sources, suggesting they would announce $2 trillion in special bonds into year end. That compares to the $1 trillion they did last year. It would take us from a slightly contractionary fiscal stance to one that's slightly expansionary on a central level. However, these more speculative investors I talked to are getting somewhat carried away, with many now looking for the announcement of a stimulus in the 5 to 10 trillion yuan range. This speculation is largely driven by comments from a couple of think tank professors recently pushing for a 10 trillion yuan stimulus. So I'm going to note two of these professors who have made a splash with these recommendations, but they differ on how the money should be spent, which I think is very telling and gets to the heart of the real problem with a mega stimulus policy. So Jia Kang, affiliated with the Ministry of Finance formerly, he heads the China Academy of New Supply Side Economics, advocates a 10 trillion stimulus to be spent on infrastructure mega projects, which he acknowledges openly will show very low economic returns. Liu Shijin, deputy director of the China Development Research Fund, suggests a 10 trillion stimulus to be spent on raising the level of public services and investments in education, healthcare, and social welfare. So one recommends infrastructure, the other consumption. Now, in my view, expenditure on that scale in either infrastructure or social benefits presents problems for Xi Jinping that outweigh the benefits to him. So in the wake of the housing bust, it's clear that the Chinese system is capable of wasting resources on a world historical scale. To many of us, this has been clear for some time, and to Xi Jinping's credit, it became clear to him, which is why he chose to burst the housing bubble. Now, everyone also knows that China has reached the point of diminishing returns on infrastructure investments, so that those investments are largely now make-work programs. And again, Jia Kang himself acknowledges this. So a return to large-scale infrastructure stimulus would essentially be an admission of defeat on the part of Xi Jinping, an open acknowledgement that his efforts to transition away from that growth model are failing. Furthermore, openly returning to an economic paradigm which everyone can now see is a dead end is extremely dangerous. It could damage Xi's personal credibility, and there's a big question as to whether the markets would see it as credible. I think you could see potentially serious instability in the currency, which, as we all know, is the last thing Chinese policymakers want. So infrastructure stimulus is dangerous. I don't think they're going to go down that path. That leaves the possibility of a large consumption stimulus, which I also think is highly risky from a political perspective, in the sense that it's ultimately incompatible with the way the Chinese economy is built to function. So the Chinese supply side is built primarily to execute upon central plans. Handing large sums of money to consumers effectively hands to the household sector the ultimate say in the allocation of capital, because capital will need to go to produce the things that households want to consume, or you'll simply have massive bottlenecks, huge inflation, and a rapid deterioration in the trade deficit. So the Chinese supply side is not set up to make that pivot in rapid fashion. And furthermore, the CCP is unlikely to want to hand that power to households, because if they start down this track of subsidizing consumption to prop up growth, it's a treadmill they can't ever exit without things just immediately falling apart again. Because this is not a short-term speed bump that this economy is dealing with. It is dealing with a multi-decade economic paradigm that has effectively fallen apart. And Xi Jinping has enunciated a clear vision of what comes next. It's what he calls high quality development, which is still a centrally planned investment-led growth model, but his hope is it for it to be a less corrupt, more efficient process of allocating capital to higher value-added sectors. Xi has also been quite clear that this transition is going to be painful. So while Chinese authorities clearly do not want to see the bottom fall out of the economy and will expand central government borrowing to backfill spending shortfalls at the local level, a 5 to 10 trillion yuan boosting of demand, which would have to be repeated and sustained for a number of years, would put the Chinese economy on a path that I do not think Xi Jinping will want to go down. And furthermore, I think he sees more strategic uses for these resources than to keep the household sector fat and happy. So to sum up, a stimulus on the order of 2 to 3 trillion makes a lot more sense to me than a mega stimulus. So I think there is a lot of scope for the market to be disappointed later this month when we start to get a sense for how big this package is going to be. Thanks.
Brian, that's super, super helpful, going through the details of the options, potential options and the consequences of each of them and the logic. That was amazingly valuable. Craig, the stimulus package has several components, and more to be named. What do you think could be most effective? Some of the things that Brian mentioned, or other things that you'd be looking for? Relatedly, most surveys of foreign companies in China, including by the U.S.-China Business Council, show a drop in their outlook for future opportunities in China. And there's been some amount of diversification, or at least new marginal investment has been heading elsewhere instead of to China. Is this stimulus the potential trigger for a turnaround in sentiment and behavior by multinationals and American companies in China? Or what other steps would multinationals and American firms in China and in boardrooms at headquarters want to see before reassessing their current China strategies?
Well, terrific, Scott, and what a great conversation thus far. For me, this moment is very reminiscent of Tokyo in 1995, and so please forgive me if I reference that a few times in my opening comments here. At least in my view, the Chinese government has had 5 objectives in the recent program. Firstly, to stabilize the property market. Secondly, to prop up the stock market. Third, to boost liquidity and encourage lending. Fourth, to support local governments. And the most important one, which all the other speakers have alluded to, is to set the stage for the fiscal stimulus, which we all expect is coming. So let me make just a couple of comments on each of the 5 objectives of the stimulus program. Real estate is an enormous part of the economy, and I think that the measures taken have been pretty significant to decrease mortgages, reduce down payments, funding unfinished projects. And then Guangdong immediately, and later Beijing and Shanghai, released purchasing restrictions on real estate. We have to remember that 70% of Chinese household wealth is in real estate. And so this is really important. I suspect that additional Chinese housing will come onto the market, and that's a good thing and a bad thing. It's great that these projects are finished, but adding to the supply without addressing to the demand is going to lead to, or could lead to, a continuation of downward pressure on housing prices. And here again, I look at Japan, where housing prices have gone down pretty consistently for a very long time. And I wonder what the increase in supply and the, if you will, balance or even reduction in demand is going to do to prices and thus household wealth. Let me talk about the stock market a little bit. We have seen an impressive pop, and I won't go through the numbers here. But those who were lucky enough to hold Chinese shares have been richly rewarded, notwithstanding no fundamental change in the economy or in corporate strategy. So that's great if you own Chinese stocks. But again, I look at Japan as a useful model. And I recall very clearly in 1995, 6, 7, when the Japanese Ministry of Finance and the Bank of Japan were engaged in furious stock purchasing operations. At that time, we called them PKOs, not peacekeeping operations, but price-keeping operations. And this definitely leads to a bump in the market, but the bump was only temporary because the fundamentals had not changed. So let's see what happens over Chinese share prices over the medium and the longer term. And I compliment Brian on his excellent analysis there. Let's talk a little bit about boosting liquidity. I think that the steps of the central bank were bold and very clear, significant, and welcome. So now the banks have plenty of money to lend, but are there borrowers? And the key test here will be not the decline in lending rates, but will there be a booming borrowing and a spurt of either investment or consumption by the private sector, either consumers or private companies over the near term? So let's see. I think in economics, we also have to be aware of the trade-offs here. And for example, Chinese insurance companies largely derive their income through the interest rates on government bonds. Those revenues have just gone down. So let's remember the trade-offs here and consider potential fragility within the Chinese financial institutions. A couple words on supporting local governments. There's no doubt that local governments and provincial governments have a huge amount of fiscal problems. There's a great deal of variation across China on this subject, but generally the picture is bleak and it's getting worse. They need transfers from the central government. Everyone realizes that these transfers alone are not effective over the longer term. But structurally, the probability of putting in an income tax, a real estate tax, or other revenue boosting mechanisms at the local or provincial level, very unclear prospects there. Certainly, the imposition of a real estate tax would not be opportune right now, given declining prices in real estate. So I understand that many local provincial governments are selling assets. That's probably a good thing, but again, it's only helpful over the short term and not the medium and the longer term. So let me add to the debate about the fiscal stimulus. I suspect that later in October, we might hear from the NPC, and we might have a better idea on how they're going to spend that money. What I think matters the most really is not how much money is spent, but where the fiscal stimulus goes. One-off cash transfers are very inefficient, as most of the money will be saved. I completely agree that additional investment in infrastructure will lead to diminishing returns. Really, what I would love to see is if the central government were to begin the process of structural reform of the social safety welfare net, increasing pensions, providing the Chinese, rural Chinese, with health care, give Liudong Renko, give the floating population unemployment insurance, improving health care and education, particularly in the rural areas, and also getting rid of hukou restrictions once and for all. The real problem within the Chinese economy, the root cause, is a lack of confidence. And only by addressing the gap in the social safety welfare net will the Chinese people and Chinese businesses feel confident enough to invest and spend again. So the lesson of Japan 1994, 1995 is don't let a good crisis go to waste. Use the crisis in a way to address the structural problems. And I think vis-a-vis American, European, and indeed I would say Chinese companies, that they're going to take a wait and see attitude here. Whether or not the reforms will lead to greater structural growth over the medium and the longer term, and they will invest accordingly. Thank you.
Thank you. Wow. I got one word answer to Craig to what you just said. Amen. Amen. That was fantastic. Everybody's terrific. I've got a gajillion questions I want to ask. Let me ask just two of them. And feel free to jump on in and tackle these. The first question in the short term. What's the one economic indicator you're looking to see that this stimulus package is biting? It's having the kind of effect you think it needs to. Obviously, stock market's already shifted, and maybe that's enough for hedge fund investors. But is there other things? I'll tell you my favorite. It's new home purchases. People willing to hand over money to buy a home that doesn't exist. I wonder if people have a different one. But I'm curious, what's the statistic you're looking at that you want to see? Second is to go back to a point that Craig made at the end, which is because we went 35 minutes without hearing the word structural, and I'm glad that Craig brought it up. So beyond the fiscal and where that money is going to go, what do we need to see in terms of structural reform, and do we need to see the stimulus align with structural reform? So he mentioned the social safety net and education and HUCO, property taxes, income taxes, maybe bankruptcy reform, so that losers lose. A lot of those things that I just mentioned, that he mentioned, actually may in the short term be contractionary, but they may be really important to do no matter what. And I guess one of the things that comes from the Japanese experience is the earlier the better, the later the worse. Delaying reform just makes the problem much, much more difficult to deal with. All right, I've thrown a couple things on the table because you all really generated me thinking quite a bit. So why don't we go back to Logan first, and then others who want to jump in, please go ahead.
Sure, thanks, Scott. And if there's problems with my microphone, apologies. I'll try to jump back in. I mean, I think the one economic indicator I would look for at this point is, it's not one, but it is indicative, something that would be indicative of household incomes and willingness to spend improving. And that could be either core CPI, which has been trending lower ever since the deleveraging campaign in 2016, 2018. That could be some other element of household consumption, because the slowdown in China has materialized even within the official data in nominal growth, in trade imbalances, the fall in Chinese imports in particular, and in the weakness in prices. Which is consistent, of course, with nominal growth. So that's sort of what I would be looking for. Let me just comment a little bit about the property market, because I think we have a slightly idiosyncratic view here, before addressing some of the structural questions. I mean, I think that the problem in the property market is actually very different depending upon where you are in China. In several interior cities, the problem is too much supply, no net in-migration, and considerable inventories as far as the eye can see that will probably never be absorbed and will probably need to be written off. The problem in coastal cities that are still seeing population inflows is ironically the opposite. No one's built anything for 2 to 3 years. And the demand is primarily from upgraders. So people who want larger homes but can't get out of their existing homes in order to upgrade. And so ironically, sell-through rates on some of these projects are pretty good. So what's available for sale is just not actually fitting the demands of most of what is there. And so it's going to take a little while for that adjustment to take place. But what you already see is land sales picking back up in many of these cities, which is indicative likely of an eventual stabilization in property construction, even as overall price levels start to continue falling. And so there is some level of equilibrium demand in China's housing market. We think it's somewhere between 550 and 750 million square meters a year, which would be about 35 to 45% of the peak levels, which was new starts at 1.71 billion square meters. But we're already down 66% in terms of annualized new starts from the peak. That happened in 3 years. It took Japan roughly 15 years to have the same pace of adjustment. So ironically, you may see property construction stabilize, because of this mismatch in supply and demand, even as broader price and financial adjustments occur elsewhere within the property market. On the structural questions, let me just say a couple of things. I think that the debate about why consumption growth is limited in China comes down to sort of four different arguments or four different views. The first is that it is based on the share of household income as a proportion of the economy, the sort of Michael Pettis view. The second is that it's based on the income inequality in the economy, the sort of Ganli China Household Finance Survey or Thomas Piketty type view. The third is that it's based on the level of household debt. And the fourth is that it's based on precautionary savings and the absence of a saving, a social safety net as such. I mean, all of these probably contribute to some extent, but it's very hard to see how you address the first two, the low household income share of GDP and the inequality and distribution of Chinese income, without a significant restructuring of the entire fiscal system. China only collects fiscal revenue based on investment-led growth. They collect value-added tax, they collect enterprise income tax. They do not collect much in domestic consumption tax nor individual income tax. And there are things you can do you can't really cut individual income tax to promote consumption. You could cut the payroll tax, but that would create and the social security contributions, but that would create different deficits therein. The broader structural constraint here is you need to figure out another source of income, fiscal income of about 5 to 6% of GDP, which is exactly what China's lost from 2015 to 2024 over the last 9 years, to replenish and potentially change the patterns of distribution of fiscal income. By our calculations, for example, if you just cut the rural savings rate in half overnight and somehow through some sort of magic wand, that would only free up about 0.6% of annual spending, of GDP and annual spending. This really is an income problem. And the only way to address that is through the fiscal system. That's all. Sorry, went on too long.
That's super helpful. Others who want to talk about the short-term indicators, Brian, or long-term? Yeah, Brian, go ahead.
Yeah. I wanted to try to cut in front of Logan there because I thought he was going to steal my indicator. I thought for sure he would say credit growth. So to me, that's sort of the be-all and end-all for the Chinese economy in a cyclical sense. And I long thought, if credit growth ever sort of goes to single digits, this economy is just not going to sustain itself. And it clearly seems to be the case because obviously there's a lot of bad debt hidden in the system that needs to be rolled. And, Craig mentioned Japan in the mid 90s. And if you look at the experience in Japan, in that case, persistent large budget deficits in the context of a strong currency did not work to get them out of the no nominal GDP rut, because in a debt deflation, particularly in the wake of an asset bust, you reveal a lot of debt as unserviceable. The people holding that debt don't want to borrow anymore. Nominal growth slows. China's in deflation, and that further disincentivizes borrowing, and you're in sort of a vicious cycle. And in China, I think there's another problem where the lower bound on interest rates probably isn't zero because of the prevalence of household deposits. They're going to need to pay those people one something, I would suspect. So they're in a classic debt deflation trap. If you look at the Ray Dalio beautiful deleveraging, it's some of the real losses get allocated, but you can't allocate the entire real loss. You need to reflate and inflate away some portion of that. And in my mind, that involves a currency devaluation. And this is the intractable problem in China because there's no way to do that without a huge mess. So to bring it back to the fiscal stimulus piece, what we saw in Japan was expanding government deficits just to keep total non-financial credit flat over that period, because the private sector retreated and the government kept coming in to fill that hole to sort of sustain things. And I think that is the pattern we're going to see in China. Now, for this stimulus to really be effective in changing the trajectory of economic growth, you would have to see it push that credit growth, do more than just make up for the decline in borrowing on the local government and private sector level, but do more than that, get that credit growth, back up to 10% something. And for that, you are talking well above 5 trillion yuan. So I don't think that's likely. And again, the stricture here is the soft peg to the dollar, which makes solving all of these problems difficult, if not impossible. I'll leave the structural stuff to others.
Yeah, Craig and Mary, there's indicators that you guys are looking for?
Well, I'm concerned about housing prices and the effect that has on confidence. We have seen declines in housing prices for a while. I appreciated Logan and Brian's comments on that, but I suspect we don't know where the bottom is on housing prices, be it in Harbin or Guizhou or Beijing, Shanghai. And I agree that they will all be different. But given the concentration of family and household wealth in housing prices, if we have a continued long-term decline in housing prices, we're going to have a continued long-term decline in consumer confidence. And I don't know where that floor is. And that is the biggest concern I would have. Related to that, we haven't mentioned deflation yet, but I do think that the decline in prices is a concern, and it's something that should be watched very, very closely. The IMF does not seem concerned about deflation, but I think that there are indicators that need to be watched and that should be addressed if we see increasing trends towards overall price declines. So those are the two numbers I would be concerned about.
Mary?
Yeah, I would agree with Craig on the deflation. All of these indicators are obviously really important to keep an eye on, but the deflation, I think one reason why we haven't heard as much about it is I think that the leadership just didn't want to talk about it. You talk to Chinese economists and they were basically, their lips were sealed until recently. So if you look 5 quarters of, falling PPI, I think is a real problem. It's not in all sectors, but this reflects weak job growth. So there is the importance of, as Craig mentioned, the fact that people's assets are very heavily into housing, but they still have to earn a living. And unless those jobs are forthcoming, and that includes people coming into the labor force. So all the graduates last year, that are still partially or unemployed, as well as migrants to the city. This is a big problem for them. When I was just in China, people were talking a lot about the insecurity caused by the weak social safety net. A lot of concern, for example, about healthcare and incomes for parents. This is for working age people who are supporting parents or worrying about the uptick in cancer, for example, in China. This is a real concern for people who are in the prime of their earning life. So I also agree that this idea of structural reform and beginning the process through healthcare reform and pension reform is really important. But that leads me back to Brian's, I think, insight, which is, will the leadership really allow consumers to drive this boat? You'd be spending a lot more money on healthcare. You'd be putting a lot more money investment into healthcare. You'd be putting a lot of money into the hands of elderly people who might want to spend it on entertainment or travel. And that seems incompatible with a regime that is, looking at this transition to the new productive forces as existential. It's not going to get them more robots. It's not going to raise TFP. So I feel that what we've been calling, they're stuck. It's a stuck transition. They're out of sync. The old has to die. The new has to be born. But in the middle, it's just a lot of pain. And I think what we're seeing with this bold announcement is that the pain that Xi Jinping promised everybody is actually probably bigger than he might have imagined. And secondly, no growth equals lack of stability. If they're focusing on stability, as everyone tells us, they're finding that they can't do that without having growth. So it's really a very interesting time to be watching the Chinese economy. That's all I can. There's just so many questions that have to be answered.
Well, let me ask you all a couple more. Those are great answers to the questions I did ask, but let me push one on domestic and one on the international. So, because this gets to something that you all have been raising, which is about the balance of power within China's political economy and whose interests are being served. And I think it was Logan who mentioned there needs to be a transfer of wealth toward workers. Well, one way to do that, well, obviously, the metric is raising wages. One way to get that is actually genuinely empower workers, right? Give them way more authority and leverage to negotiate wages. That might come through a whole variety of different kinds of mechanisms. We've not discussed here youth unemployment, which one of our audience members raised. Maybe we didn't discuss it because it's hard to find that piece of data in Chinese data anymore, but it's quite high. So at the entry level workers are amazingly concerned about their job opportunities, and folks at the other end, retirees, are worried. The adjustments in the retirement age were quite limited and only going to be phased in for a long time, but you've got to address those concerns as well. So I was curious, what do you think about the challenges of China's economy with regard to workers and labor? The second is on the international side. This highlights to me the contradictions between and trade-offs in trying to achieve different kinds of goals. If you had greater net exports, that would go to the bottom line of growth, but that would upset a whole bunch of trading partners, right? And so it seemed to me one way to you might choose instead to increase imports and try and figure out how to smooth over relations with the United States and others, because actually another source of uncertainty and low confidence in China is the unpredictability of global tensions and how long those might last. Of course, if you follow Brian's advice and say what you need is to weaken the RMB, that goes against that goal. So what should be the priority on the international side, to boost exports or boost imports and kiss and make up with the West? So both kinds of questions, one on the domestic side, one on the international side. I want to turn to Craig first on those.
Well, I would argue that the key here is to empower the Chinese private sector and to expand the service sector. The one thing that we have not seen in this batch of fiscal or monetary stimulus, and which we did not see in the third plenum, was reform of the state-owned enterprise system at the central government level. Now, I mentioned that there's asset sales at the local level and the provincial level, but we're not seeing that at the central government level. And at least in my view, that's an essential part of the package here, to give the private Chinese companies room to grow. SOEs need to be preferably sold off, but if not, disciplined to provide their returns back to the Chinese people and give private sector Chinese companies and multinationals more room to grow, to allow for more competitive markets in China, not those dominated by a few major SOE players. So I think that without that element of reform, you're not going to be able to find the equilibrium that you're looking for. Also, you know, if manufacturing and services, compared, Chinese has an Arnold Schwarzenegger-like manufacturing torso on a Woody Allen-like services legs, and it's not really working well. The service industry can be expanded very significantly, and foreign players can play an important role in doing that. So I look at those three, I guess, sets of reforms as being critical. Thank you.
All right. Who else wants to jump in here? Mary.
Yeah, I mean, that's a great jumping off point, Craig. I think that, Craig's absolutely right. When we look at the SOEs, I think it reflects a bigger problem, which is a failure to actually address the political economy that's leading to the economy being stuck. And, in the United States, we see the same issue. You have, for example, some legacy companies that don't see the future as being for them. And then we have to kind of find a way forward politically to create new industries. But, we're seeing it with a failure to really scale down steel. Now the developers, what are we going to do? We have to buy them off, or, how much of their capital will be preserved in this process. We know eventually the households will end up eating the debt. All that process has to be done. It's a huge political economy problem. So as is disciplining the SOEs, which is vitally important because competition, entry, and exit, of course, was the secret sauce for China. And we've seen those metrics decline. I think it's also, you say, should we boost exports, boost imports? Well, of course, those are largely made by private decisions. And so they can't, unless you're thinking about the phase one deal where you magically wave a wand and supposedly increase Chinese imports, which of course never materialized, you have to set the stage for how that's going to happen. And I think part of that is by making these structural reforms in the private sector and in the SOE sector to get that going, as well as decreasing tensions. And clearly, tackling some of these political economy questions would, I think, show that the Chinese understand that the West is not going to allow certain things like that happened in the past, for example, in solar, to happen in EV or other sectors, and may reduce the tension. So something structural, I think, is necessary to bring as an olive branch to the rest of the world. Just telling them that, everybody needs EVs is just really not working, and yet they continue to double down on that.
Yeah. Brian, Logan?
Yeah, Brian, I'll be very brief if that's all right. I mean, I think that, Scott, you asked, these questions are very much linked because a lot of the problems of China's political economy at this point and the distributional issues that affect workers, especially younger workers, are very much related to this persistence and investment-led growth that generates international tensions. And the problem here is that Beijing likes to describe these pains that are going on as transitional when you're moving to new growth drivers in which the labor force will adjust. Many of these new growth drivers are not very labor intensive. They are very automated industries. They're very capital intensive industries. The question remains, what happens after that? And this is the broader problem that, just picking up on what Mary started with and the comments just now, which is that China is one of the world's largest sources of investment. It's about 26% of global investment, only 12% by our calculations of global consumption. So if you remain an investment-led economy and you're expanding, the only way in which that can work and China can grow relative to the rest of the world is either to have other countries disinvest or go out of business, or to gain global export market share. That's exactly why this strategy is so confrontational at this point, and you're seeing the kind of resistance you are to China's approach, and why some sort of structural down payment and discussing these issues in different ways, rather than just saying we are pursuing an investment-led growth strategy focused on advanced manufacturing, is going to be necessary to prevent trade tensions from intensifying.
Brian?
Just some quick points. I know we're nearing the top of the hour. There was a Caixin article this week about, I think it was the first state-owned construction company defaulting. So the labor force problems are going to be severe and persistent because, this real estate bust is unfolding in waves. This could be several years. So, the developers are gone to a large extent. These construction companies have been paid in empty apartments, and then the suppliers to the construction companies are next. And I don't think Xi Jinping has any choice but to gamble that the rest of the world will accept Chinese imports because he absolutely needs to sustain that base of employment. And I'm not convinced it's a bad bet. Just as an aside, if Donald Trump should get reelected, I think he's not going to focus on China in the first couple of years in what could be a tenuous domestic economic environment and a lot of other things he wants to get done that are economically destabilizing. So somewhat counterintuitively, I think, she could catch a break there for a couple of years. And, the European auto tariffs are not nothing, but they're not really going to change the calculus. So I think, continuing to pump exports is really all he can do, because to sort of sum up the discussion we've had today, there's this chasm between what China should do to fix this thing and what they can do given the self-imposed constraints on how they run the system. And there's just really no solving that one. So, I think they're going to have to continue to export at a high rate. It's all they have.
This has been a terrific conversation, extremely informative on a whole number of levels. I think what this shows is that the actions that the Chinese took in the last week of September have changed the conversation. That now we are talking about the beginning of trying to not just get the economy started and growing, but what else needs to be done. And you all outlined what needs to be done on the fiscal side, as well as on the structural side, which they still need to fill in the blanks. And how they fill in those blanks is going to matter a lot, because it's going to that will be what changes the behavior of Chinese consumers, the private sector, foreign institutional investors, as well as foreign governments and others. So they've turned a page. We're going to look to see what the next chapters look like to understand where the economy is going to go. At the same time, yes, as Brian said, they face a whole variety of constraints, economic and political. So they're going to need to be more creative than they've been in how they write this story to really fundamentally change expectations. That does mean tough medicine, but it may be the medicine that they need. Thank you all, Craig, Mary, Logan, Brian, for joining us today. For all of you watching, thank you for your questions and ideas. This conversation is far from over. Thank you all, and hope you all have a great day.
Thank you.
Thank you.